Hello, everybody. Welcome to the Ag Commodity Corner Plus podcast. It's week 27, and today is September the 26th, 2025. As you guys can see, it's just me doing the podcast this week. Mo's away for the week. He'll be back next week. It's been a pretty eventful week as far as the markets are concerned, and we'll get into some of the factors that affected the market this week. The topic for this week's podcast is cheap Argentine soybean exports plus safe haven trade momentum. Let's start by, as we usually do, start by looking at what the markets did during the week. As you guys can see, a lot of red as far as the grains markets are concerned. Corn closed lower by about 2 cents. Soybeans off by about 12 cents, and we'll get into the factors that affected the soybeans market this week. Canola lower, wheat lower for the week. Onto the livestock side of things, lean hogs closed higher, up by about 3.63. The October contract closed at 101.5. We had the USDA quarterly hogs and pigs report, which came out yesterday, and that was friendly to bullish as far as the hog market is concerned. No real expansion happening, whereas there seems to be more contraction happening when we look at some of the numbers there. Moving on and looking at the macro markets, it was a bit of a risk-off trade week, and the stock indices, including the big ones, all closed lower for the week. Bitcoin also lower for the week. On the other hand, though, safe haven trade and looking at gold and silver, which are some of the primary safe haven commodities, they went into record territory or otherwise closed higher for the week. And a lot of that is owing to economic uncertainty, the trade war situation that's been going on, and general uncertainty as far as the economy is concerned. So gold into record territory, and silver went to the highest since 2011. Let's start by looking at the major headlines that affected the grains markets this week. Argentina suspended their agro-export taxes. So they dropped it from around 26% to zero, with the objective of increasing their US dollar reserves. The Argentine economy has been ailing for a while, and they have on and off issues every now and then, the economy in Argentina. Their objective supposedly was to increase their US dollar reserves by about 7 billion US dollars. And this, for want of a better word, this export tax holiday lasted for about 3 days during the week, by which time they were able to hit their objective of that 7 billion USD. What this did was this enabled importing countries, especially the big importers like China, to increase their soybean reserves. China supposedly bought about 35 cargoes of cheap Argentine soybeans. And China's soybean reserves are supposed to have increased to 6 million metric tons, which should hold them in good stead until the end of the year at least, by which time and towards the early part of next year, we have that big Brazilian soybean crop hitting the export pipelines. But as far as the US is concerned, this came at the wrong time because, as we know, the US and China are in talks and in discussions to find that US-China trade deal. The availability of cheap soybeans works against reaching that objective. And the US soybean export program is off to its worst start in recent history, and so far there have been no official soybean sales from the US to China. There have been sales to unknown, quote-unquote, destinations, which a lot of it could eventually get redirected as Chinese sales. But as of now, it is unprecedented that we don't have any sales to China so far for the for the 25-26 U.S. soybean export program. And to add to that, today there was headline news that China has started an anti-dumping probe into pecan nut exports from Mexico and U.S. So that trade situation, this is not going to help that situation there. And as far as the soybean export situation from Argentina is concerned, they are not the biggest as far as soybean exports are concerned when you compare them to Brazil and the US, but they are the biggest soy meal exporter. So the local industry, which crushes the soybeans to meal, they were also a bit concerned with this export tax holiday. Because it tightens the supply for the local soy meal industry. And sticking with the Argentina situation, there was also headlines that the U.S. is looking to aid the Argentine economy, which has its issues every now and then. The Argentine, the country is looking towards, looking forward to midterm elections next month. So this exercise of the export, the agro-export tax holiday, and also reaching out to the U.S. for aid, all of that is to improve the economic outlook as far as Argentina is concerned ahead of the election. So the U.S. supposedly has agreed to buy Argentine dollar bonds and thus sort of support the economy and also provide financial aid for Argentina. But as far as the ag industry is concerned, this again raised concerns because it's basically aiding a competitor for ag and also for soybean exports at a time when the U.S. and China are in discussions for that trade deal. What all of that did to the soybean market was that it weighed heavily on it. So last week we spoke about the Trump-Xi trade talks that happened, the high-level trade talks, which did not lead to anything concrete. Soybean markets fell off since then. We had a major drop that day, and that continued into this week, also due to that Argentine soybean situation. We are currently, the November contract is trading close to 10.13. The resistance comes in at 10.4, 10.42. We need to break above that to move higher, but as of now, it's trading within that range. When the U.S. soybean export program for 25-26 is not doing so well, the U.S. corn export program is actually off to a very strong start, and we've been talking about that. As far as the latest year-to-date soybean export sales for 25-26 is concerned, we are at record highs. So to give you some numbers, for 25-26, year-to-date exports hit 25.76 million metric tons, which is the highest for the date. And this beats the prior record from 2021. And the interesting fact is that in 2021, 48% of the sales year to date that year was to China. The current record is without Chinese sales for 25-26. And as far as the latest weekly export sales is concerned, 2/3 of it went to Mexico. And basically, so it just underlines how crucial Mexico is as far as U.S. corn export trade and ag in general, ag exports from the U.S. in general is concerned. Sticking with the U.S. grain sector, looking at the drought situation, this is the latest drought monitor on the left. And that compares to, on the right, you have September 2011. Currently, about 54.5% of the U.S. Midwest is in some form of drought, and that compares to 41.5% from September 2011. And as we know, the year after 2011, 2012 was when we had that major drought in the U.S. Midwest. As of now, this week and the prior week, there were some showers and rains that hit some of those regions, but a lot of the regions that needed the rains and could have benefited, the crops in those regions could have benefited from it. They did not get it, and also the outlook for the next couple of weeks looks to be dry for the U.S. Midwest. So the yield projections are being chalked down. Some of the private estimates as far as the U.S. corn yield has dropped to 182 bushels per acre. There are thoughts of it dropping even below 180. USDA is at that 186 to 187 range as of now. Come October and the October WASDE crop report, the likelihood is that we could see it cut down even more. Also, as far as market moving or otherwise major reports are concerned, next week we have the quarterly grain stocks report, which could provide a surprise, especially for soybeans and wheat if it comes in lower than what the trade is expecting. As far as corn is concerned, and owing to that strong demand and exports, already trade is expecting it to be lower year on year. Trade expectations are for 1.34 billion bushels. USDA could surprise coming in lower than any of those trade estimates. Also, guys, don't forget to try our marketing program for free. The link to it, you'll find that in the description. We have the app, which will help you to improve your marketing decisions on the go. And also, guys, don't forget to join our marketing club. This week, we dug deep into that U.S. soybean export program and also the longer term outlook for it, given the China hangover, the China trade deal hangover as well. We also looked at the hogs and pigs report, which came out this week, and how that would impact the hog futures. And looking at that second part of today's podcast title, the safe haven trade, this is a chart of gold futures, the weekly chart, and we are into record high territories as far as the safe haven commodity is concerned. And the other one, silver as well, is also at its highest since 2011, excuse me. And all of that is owing to market anxiety and market concern over economic uncertainty. Some of the numbers that came out from the U.S. Is pointing towards another rate cut by the U.S. Fed next month, and the safe haven commodities started climbing once the expectation for that rate cut kept increasing. Or as of now, trade is expecting over 80% chance of a rate cut in October. Recently, we had the U.S. release their jobless claims numbers, which came in lower than what the trade was expecting, which again supports the idea of a rate cut come October. Also, today's PCE inflation numbers from the U.S. also was as expected and close to the U.S. Fed's target range. Again, all of that, the economy, the GDP numbers also were reworked to be higher than what it was before. All of that works towards the expectation of another rate cut in October. This is the CME Fed Watch tool, which shows that towards the left, we should have another 25 basis point cut in U.S. central interest rates, dropping it down to that 3.75 to 4% range. There are some market ideas that eventually, towards the end of the year, the target for the U.S. Fed could be to reach that 3.5 to 3.75 range, so another cut possibly, but a lot of moving parts involved in that decision. Looking at high-level talks and also the U.S. trade situation, this time it's between U.S. and India. There are trade talks ongoing, and also headlines that stated that that India is trying to purchase more crude oil from the U.S. to increase their crude oil purchases from the U.S. Um, the current tariff situation between the two countries is that Indian exports to the US are being tariffed at 50%. So this is again another plan to try and find a trade deal there as well. The US has been against India buying Russian crude oil, and due to all of that, the trade war between the two countries has been heightening. The H-1B visa situation also comes into play here. A lot of the skilled worker migration from India to the US also was impacted when the US increased the H-1B visa fees to 100,000 per person from 10,000, which impacted some of the employers who were relying on that skilled trade migration to the US. So all these discussions are aimed at reaching a trade deal and eventually fixing all those issues as far as bilateral trade between the two countries are concerned. In looking at the livestock markets and the USDA quarterly hogs and pigs report, which came out yesterday, as you guys can see, there a lot of the numbers there are lower than what the trade was expecting, which is bullish for the hogs market. The hogs, the average hog US price for September currently for 2025 is at record high territory, and this beats also the PEDV, the disease year of 2014. So currently the average prices are at record highs, and that should continue as we look ahead to next month as well. On the whole, this report just shows that there is more contraction rather than the market trying to expand. There's also that substitution as far as consumer demand is concerned. So basically the fundamentals as far as hogs are concerned, nothing much has changed. There's tightness as far as supply is concerned, and there's also strong consumer demand. The substitution that I was talking about has got to do with sky high beef prices, and hence consumers are preferring to spend more on pork rather than beef, and all of that has been helping pork demand, and hence has been helping these lean hog futures, and that should continue into October as well. That's all I have for this week. Thank you for joining us, and have a great weekend, and talk to you guys next week. Take care, guys. Bye.